Hello, I'm Bernard Hickey from interest.co.nz and welcome here to another in our double shot series of interviews where we talk to ministers or CEOs or someone who's saying something interesting about the housing market, the economy, interest rates, that sort of thing. And today we have Bill English, the Finance Minister, in here at interest.co.nz. Welcome in, Bill.
Thanks, Bernard.
You've been in the last month or two talking about the budget. What's your assessment of how the budget's been received, and do you think you've done enough in the budget to sort out the economy's problems?
Well, in answer to the first question, it's been received quite well, surprisingly well perhaps. I think it shows the benefit of going through a process where people can see the logic of what we're doing. So I've given two or three dozen speeches around the country with a very wide range of audiences, and they certainly understand the logic that consumption and borrowing has been a bit excessive, not saving enough, and we definitely need to upgrade our earning capacity as a country, particularly if we want to deal with this stock of debt that we've built up. Have we done enough? The answer to that is no. The style of this government, particularly the style of John Key, is considered and consistent change over time. So whatever we've done in the budget, we'll be going back to some of the same areas. We've got to look at other areas where we haven't moved far enough, because the challenges for the economy are quite long running, particularly dealing with New Zealand's private sector appetite for debt, households in particular, businesses not so much. That's going to be a long job, and so considered and consistent change over time. We've got one budget where we've made some significant moves, and now we're starting to get our heads and our processes organised for the next one, because we'll need more change on a reasonable scale to make further progress. What
more could you change on the property taxation area?
Well, that's an open question. I think the changes we've made were pretty balanced and moderate. Didn't go as far as, I say, people like yourself would have liked to seen us go. Probably to the edge of the tolerance of a lot of the smaller and highly leveraged investors in the property community. So again, we're not going to rule anything in or out. We're open-minded about propositions that are going to further try and rebalance the economy. So I think it's important for people to understand we don't regard the job as done.
There's a couple of areas that people have looked at: a bright line test, and also perhaps more aggressive ring fencing of losses around vehicles for investing in property. What's your view on those two areas?
Those are areas we had a pretty hard look at through the budget process, and came to the conclusion that it was difficult to make them work without creating another avoidance industry. And in a political sense, or if people think they're unfair, they just get undone, and that's happened in Australia and in New Zealand in the past. I think we're also a bit uneasy about discriminating too much on particular asset classes. We have a general issue about effective tax rates on savings and on debt. And there's no doubt the effective tax rates on leveraged investment in New Zealand have been pretty low, and the effective tax rates on money in the bank has been very high, particularly in a low inflation environment. So that's an area where we'll be doing a bit of thinking.
All around the world, governments, except perhaps for America, are looking to cut their budget deficits and make sure they don't get beaten up by the bond vigilantes. Has New Zealand done enough to stop being beaten up by the bond vigilantes at some stage?
Again, I'd say no, not enough. Our vulnerability to those grumpy debt markets is actually growing over the next 4 or 5 years. Our net external liabilities will move from about 170 billion to somewhere up 240, 250, close to 100% of GDP. And that's going to be driven significantly by government borrowing, whereas in the last decade it's been driven significantly by private borrowing and private debt. On the fiscal side, we've still got fairly significant stimulus. We've got a fairly large deficit in this next year. We've got a track that shows it improving, but we really do need to make sure that that improving track is locked in by actual decisions, not just by assumptions. So the government's got a lot of work to do just to get the public sector to fit what we've already built into the forecasts.
Do you think our economy can survive if we do quieten down the housing sector? And have we done enough to switch it to the exporting side? Because there's some people who say we were a housing market with, including me, a housing market with bits tacked on. If we quieten it down, there won't be much left unless we make a big switch to exporting. Have we done enough to make that switch?
I don't think we've done enough yet, but the early signs are promising. And just a couple of things. There are some indicators. One is just that credit is pretty flat. Business credit is still negative, which is a bit of a concern. That needs to turn around. But our households aren't running back to the housing market in a big way. They're not going on a big spend up. They're being pretty cautious. And on the positive side, our export prices are up. Now that's a bit conditional on China maintaining its momentum, but nevertheless they're up. And the Fonterra vote yesterday, I think, is probably one of the most significant things that have happened this year, both in terms of some confidence in what's our main export driver and the people who own it, and the opportunities for capital markets that will come off the kind of capital structure change that they're talking about. So we think the early signs are promising, but it's going to take a lot of hard work to keep pushing in that direction. The good news is we're moving in that direction. It's a matter of how hard we can push with it.
So Bill, Labor has said that we need more tools and different targets for monetary policy than we have at the moment. What's your view on this?
I think it's a bit academic. Look, there's other central banks have slightly different mandates. Doesn't make much difference to the decisions they're making. And in any case, we need to keep it in perspective. I think 3 or 4 years ago that was a big deal. At the height of this consumption and government spending-driven cycle, we pushed the framework to the limits. But now I think the macroprudential activities of the Reserve Bank are of a great deal more interest, making more difference than some semantic change in the policy targets agreement. And both of those things are somewhat peripheral compared to the ongoing deleveraging process.
Do you think New Zealanders understand what that global deleveraging would mean for the economy in the next few years?
They're starting to wonder because they're hearing a fair bit about it. They're developing, I think, a reasonably realistic view about their own situation and the need to reduce their debt. And as they see interest rates starting to pick up, I think that's really going to be driven home. But they're also starting to ask me in public meetings, and what difference does it make, all the stuff going on in Europe and the UK? And I think we're all a bit unclear about the channels by which that will feed back into New Zealand. What we can be clear about is those economies are going to have pretty grumpy consumers and difficult politics for the next decade.
And just coming back to New Zealand again, there's been a lot of discussion around the decision to put Alan Hubbard into statutory management. You're a rural MP from the South Island. What reaction are you getting from people in the South Island, and what's your view on whether South Canterbury Finance has a future past the end of the guarantee?
Well, I certainly wouldn't take a view about it, either the individuals or the companies involved. I mean, the government guarantee will protect the depositors of South Canterbury Finance if anything happens, the same as it would protect depositors in any institution if anything happens. There's a bit of concern about it. I mean, in the end, these are regulatory issues, not political ones, and they need to be handled that way, particularly in this case, because the government would have to be pretty careful about using its regulatory position to favour its own exposure, which is an aspect of it hasn't really been debated. We've got to be very careful that the government doesn't act in a way that's designed to minimise its own risks as a guarantor. The regulatory agencies need to act in quite an independent manner, regardless of what exposure the government has.
Right. And just finally, house prices. Our audience is very interested in house prices. What's your view on property values, house values in New Zealand?
Well, I'm a bit of a fundamentalist, Bernard, and that is the ratios of prices to income are just historically significantly out of line in New Zealand and Australia, more so than most other countries. I think Spain and Ireland had those ratios, but they're changed. So I'm still waiting for the theory. I'm open-minded enough to be waiting for the theory that explains why a housing market would stay out of line with where it's been for the last 30 or 40 years. And it's a very real concern in the sense that for young New Zealanders, the prospect of house ownership, home ownership with these kind of ratios is very, very hard for them to imagine, particularly when returns to saving are so low with low interest rates. So I'm still waiting for that theory. I know that your readers say you're wrong about the 30% reduction, but I've yet to see the theory that justifies why in the long run you will be wrong.
Bill Angus, thank you very much. That was another Double Shot interview here on interest.co.nz.